In the stock market, many investors are taught that a low price-to-book ratio is the ultimate signal of a bargain. The logic feels sound. If a stock trades below its book value, you are theoretically paying less than the value of the company's physical assets. It carries the same psychological appeal as buying a massive million-dollar house for half its construction cost. You walk through the front door and look at the square footage, confident that you've outsmarted the market by paying a fraction of what it costs to build. But consider the value of that house if it's next to a landfill, has a collapsing foundation, or sits in an unwanted location. In that context, the low price isn't a mistake, it's an accurate reflection of the property's utility. When beginners screen the market looking exclusively for these low price-to-book ratios, they often ignore why the price is low in the first place. This leads to portfolios filled with companies that look inexpensive on paper, but struggle to grow in reality. Buying assets strictly based on a markdown creates a mathematical illusion. Without looking at how those assets perform, cheap can quickly become a permanent state rather than an opportunity. This chart shows the basic calculation for book value. You take a company's total assets and subtract the liabilities. What remains is the book value, the theoretical amount shareholders would receive if the business shut down and sold everything today. Imagine two businesses, Company Alpha and Company Beta. They have identical balance sheets and both report a book value of 5 rupees per share. However, the market prices these two companies very differently. Alpha trades at 10 rupees, while Beta trades for just 3 rupees. When we divide these prices by the 5 rupee book value, we get our ratios. Alpha trades at 2 times book value. Beta trades at 0.6 times book value. A beginner looking at these numbers would likely flock to Company Beta. It looks as though they are buying 5 rupees worth of corporate assets for a 3 rupee entry price. On the surface, Beta is the obvious bargain. But this single metric hides a deeper financial reality that changes the entire calculation. We can see that reality by looking at how these assets actually function. This is measured by return on equity, or ROE. It reveals how much profit a company generates for every rupee of shareholder equity. Company Alpha is highly efficient. It produces 100 rupees in net income, which results in a 20% return on equity. Company Beta struggles. Despite having the same amount of equity, it only generates 10 rupees in income. Its return on equity is a dismal 2%. Beta's assets aren't a bargain, they are unproductive. The market prices them at a discount because they fail to generate meaningful returns for the owners. This diagram compares the two companies using the price-to-earnings, or PE ratio. This shifts our focus from the cost of the assets to the cost of the income they produce. Alpha trades at 10 rupees with earnings of 1 rupee per share, giving it a PE ratio of 10. Its strong profitability makes this a reasonable price to pay for its earnings power. Beta trades at only 3 rupees, but because it only earns 10 paise per share, its PE ratio jumps to 30. The stock that looked cheap on an asset basis is actually 3 times more expensive when measured by its earnings. This is a value trap. It looks like a discount, but because the business lacks the earnings power to grow, the market has no reason to ever revalue it. It stays cheap because it is worth less to an investor. The idea that buying below book value offers a margin of safety assumes that every asset on a balance sheet is worth its recorded price. In reality, many balance sheets are weighted down by items that have little real-world value. Cash and prime real estate are liquid and hold their value, but an idle factory or inventory that no one wants to buy are essentially worthless, even if they are still listed as assets by the accountants. Experienced investors use this to screen the market. A low price-to-book ratio combined with a weak ROE is a red flag for structural failure. Conversely, a low price-to-book with an improving ROE can signal a business that is genuinely undervalued. Book value is an accounting starting point. Relying on it without analyzing the quality and productivity of the underlying assets often leads to poor investment decisions. Many of the world's most successful companies trade at high price-to-book ratios. Investors pay a premium because these businesses deploy their assets with extreme efficiency, generating high returns year after year. In the choice between Alpha and Beta, the higher-priced Alpha is often the superior investment. Business performance and the ability to generate cash outweigh a low entry price. A low valuation ratio is not a shortcut to wealth. It is a prompt to investigate the financial engine of the company to see if the price is low for a good reason. Productivity dictates value. The smartest investors prioritize what an asset generates over what it costs to acquire.